This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Welcome back to Insight is Capital. I'm your host, Pierre Daly. In this episode, Martin Lefebvre, Chief Investment Officer at National Bank Investments, joins me to talk about his team's take and outlook for the economy, fixed income, and equities. Martin has over 20 years of experience in financial markets where he has held various key positions. He joined National Bank in April of 2012 as a strategist before moving on to Private Banking 1859, where he oversaw the portfolio management team. As Chief Investment Officer, he is now responsible for the development of investment solutions for National Bank Investments and the management of tactical asset allocation mandates. Prior to his years at the bank, he worked at NatCan Investment Management as Vice President, Asset Allocation, where he was responsible for the portfolio management of several multiple asset class mandates. Thank you again for joining us, and without further ado, my conversation with Martin Lefebvre. Martin, welcome back to the show, and thanks so much for joining us at this moment.
It's my pleasure, as always,
It's great to have you back again. This is your second time on the show. It's been quite a year. U.S. stocks are at all-time highs. Long-term bond yields have been falling as markets signaled weakness during the past 2 quarters, all in the context of a still strong labor market, albeit with unemployment rising a little bit. And it's been a tale of 2 cities, one dominated by net savers, the other by net borrowers. And inflation, stubborn inflation, subsiding, but still continuing to cause a fair amount of uncertainty, right?
Absolutely. Some investors are surprised to see that the markets where they're sitting right now with new highs on the S&P 500. There's been a little bit of leadership change as of late. The Magnificent Seven, are lagging a little bit ever since the change in the labor market, the softening of the labor market sometime in July, and the expectations of rate cuts. And obviously, we'll talk about that in length in a couple minutes. But I guess after the pullback that we got in 2022, following the start of this unprecedented monetary tightening, I guess we shouldn't be surprised to see that the markets are behaving the way they are, especially knowing that inflation has come down markedly while economic growth in the U.S. has remained very robust above potential, almost at 3%. And when you look at stats like GDP now, it's still forecasting that the third and fourth quarter will be fairly strong. So it's not really surprising, and perhaps out of the norms following a monetary tightening the way we saw.
Well, finally, markets got the highly welcome Fed rate cut in September. And what do you think was behind the Fed's bold decision to go with the 50 beeps cut to kick off easing?
Yeah, it was a bit of a surprise. It was coin toss. Some people were expecting only 25 bips. I think that the Fed was ready already in July, but they wanted to wait for a little bit more information, and I guess they was just ready. And with the softening of the job market in July, as I said in the introduction, it was time for them to cut rates. So they did that. If we go back in time a little bit and recall the Fed's objective to engineer a soft landing, with inflation coming down, it was time for them to focus their attention on the unemployment rate, which has gone up a little bit over the past couple of months, to a point where it was important for them to switch gear and say, we've done our job, mission accomplished on the inflation front, and now we don't want, and it was very, Powell was very adamant saying that we don't want the unemployment rate to deteriorate much more from this point on. So it was obvious that there was going to be some rate cuts. Now, was the 50 bips necessary? I think that it was. if you want to engineer a soft landing, obviously it's a state. So what's a soft landing? Well, you want to make sure that inflation comes down, but without provoking a recession. So if you want in economic growth to remain above potential, then you need to have the neutral rate somewhere around 3%, much faster than what was expected by markets. So they kind of said that, but I don't think that the 50 bips is necessarily the way to go in the near future. They might decide to go by down by 25 bips in the next Fed decision which will be at the end of October, just to see how it goes and if the job market remains fairly robust or if there's a further deterioration in the unemployment rate.
Well, yeah, I mean, it was quite a nice surprise. I think, it was so highly anticipated for so long. And finally, at least, it appears that the Fed is doing a little bit of catch up as well, too, in terms of catching up to the rest of the developed world economies, having started their cutting, like Canada, for example, cutting much sooner than the U.S. was prepared to move. So, Martin, what do you think is in store for long-term yields and your fixed income strategies, especially given some of the economic fragility that we're seeing?
Yeah, that's a good question. And you probably saw that following the Fed decision that the rate market didn't move very much. It remained fairly stable. And I guess in that 50 bips reduction, there could be two things. We were waiting for the decision, wondering what a 50 bips rate cut would have in terms of implication for the markets. And it was kind of twofold. Obviously, if the message was strong that the work was done and that inflation had come down, enough to a point where they were in a position where they could lower interest rates to maintain that perception of soft landing, we thought that would be good. And obviously, we saw that the stock market went up, to new highs. So that's a clear positive. But for the bond market, the reaction was kind of a different, because now it's, okay, there's going to be a soft landing. If there's a soft landing, then perhaps inflation is not going to come down, as much as it possibly could in a recession scenario. And just because of that, we saw that yields have started to stabilize around the current level. But then there was a lot already priced in that softening of the labor market probably was already priced in. Yields had come down, not from a recent high of nearly 5%, but probably 50 bips lower than what it was just about a month and a half ago. So for us, it seems that yields may not have to go, much lower from this point on. But for us, the risk in this scenario is to the downside.
Right.
You probably recall that with the softening of the labor market, there was this triggering of what we call the SAM rule.
Right. Yeah.
The SAM rule is when there's a deterioration of a 0.5 percentage point in the unemployment rate from its level a year ago. And historically, it has always led to some form of slowdown or worse, the recession. If you go back all the way to the 1960s, it's infallible almost. So we have to monitor that very closely. We have to listen to this signal, but it doesn't mean that, it could be the exception to the rule. And right now, what we're seeing is that the stock market is there. The consumers are still there, even though the job market has deteriorated a little bit. The unemployment rate remains at a fairly low level. It's still at full, employment almost as we speak today. Wages are still there, so there isn't that much risk that could have the U.S. economy tilt in a full-blown recession. So we still have to monitor that. But for this time being, it seems that even though risks remain tilted to the downside, that going very long duration in our bond strategy doesn't seem to be appropriate this time around.
Right. What are you doing to adjust your asset allocation to navigate this recession risk? Where are you targeting duration in your fixed income portfolios?
Yes, we're still slightly overweight duration, but let's say your benchmark is 7 years, which probably like half a year, 1 year at most, over duration in terms of asset allocation. We're still neutral in our global positioning in terms of stocks and bonds. Most of our models are pointing to that, whether it's the momentum is still there in the equity markets, that's for sure. But if you look at the cyclicality, if you look at manufacturing, that slowed down a little bit. If you look at many things that we tend to look at as strategists, it's kind of telling you that risks are, remain tilted to the downside. So, like I said, there might be an exception to the rule in terms of the triggering of the SAM rule, but
Yeah.
it's the same thing in terms of monetary tightening. Usually, the Fed, they always wait at the last minute before they start lowering interest rates. So the fact that they've done that just now, historically, it's always been an indication that it's too late and that there's going to be a recession. Now, you have
Right.
to recall, why hasn't there been a slowdown yet? The monetary tightening started nearly 2 years ago, and actually more than that. It was in March of 2022, but the monetary policy became restrictive about 2 years ago, and yet we haven't seen the slowdown
Right.
or was a recession just yet. And part of that is linked to the fact that while the Fed was hitting the brakes, then the government was, full blown pedal to the metal
Yeah.
building huge deficits and trying to kickstart the economy with all sorts of bills, whether the CHIPS Act or the Inflation Reduction Act, sending checks to households in the U.S. So that was kind of an offset to what the Fed was trying to achieve on the one end, and then on the other end, perhaps another big offset was the fact that we had all of this excess savings that was built on the part of households in the U.S. that was utilized to
Right.
offset the increase in prices over the course of 2022 and 2023. And that, as we know, is almost completely depleted. So we have to be, careful in our analysis of the U.S. economy going forward. There was a few things that were positive that are now gone. It's going to be very difficult. There's an election coming. It's going to be very difficult, whether it's Trump or Harris that takes the White House to build, even bigger deficits going forward. And households will probably be a little bit more prudent in their approach in 2025. So the risk of a slowdown is still very much present. And that's why, for the time being, we're still working with a soft landing scenario, just like probably 80% of the investors out there. When you look at Bank of America Merrill Lynch fund manager survey, it's still telling you that most folks out there, investors, expect the Fed to engineer a soft landing. But like I said, historically, it's always been very difficult for them to do that. And that's why we need to be careful in our approach as well.
I mean, there's some broad differences between, us here in Canada looking across the border at the U.S. There's some broad differences in the way that our economies run. I mean, first of all, lending practices where mortgages are concerned. I mean, a lot of homeowners in the U.S. have 30-year mortgages that are locked in at very low rates, sub 4, sub 3 in some cases.
Yep.
Right. And so a lot of the pricing pressure that we saw, didn't really affect them. Even the lagging effects of rate hikes didn't really bother a lot of homeowners in the US because they're locked in. But here in Canada, it's a different story because a lot of mortgages are coming up to coming into their 5-year terms, and that was kind of what I was alluding to at the beginning, where I said, it's a tale of two cities. We've got, all the benefits going to net savers of higher rates, higher yields, investments that are paying 3, 4, 5% a year, and stocks at all-time highs. And so, net savers have benefited greatly from the dynamics of this economy, but net borrowers have not, right? And where net borrowers are under pressure because of rates having risen, as much as they did in the last 4 years, and only now beginning to subside. there's still quite a lot of lagging effects that are creating a fair bit of uncertainty, depending on how quickly the easing happens and how quickly home mortgage rates come down here, this side of the border. But in the U.S., that doesn't seem to be as much of a concern. But of course, the focus is a lot of the focus is on the tightness of the labor market coming off a little bit, and inflation.
But
The rate
even
of,
in the U.S., Ken, if you it's true. I mean, if you have a 30-year mortgage and you signed up at 1%, I mean, the incentive to say, oh no, I want a bigger house and I want a mortgage at 7, 8, 9% is not really there. But
yeah, people are stuck. I mean, people are stuck in their current homes because of their 30-year rates. So
yeah,
mobility is down, right? The ability to move to another city, another job, if you have to, is kind of, it's not there. It doesn't exist. I mean, being able to do that, unless you can commute. But for most people, that means staying put and trying to stay in your your current home, your current city.
but it doesn't mean that the impact will not happen nonetheless. It's
Right,
probably
right.
slowed down because of that, because of the fast increase or unprecedented increase in interest rates. But the economy is still doing well. Some folks want to become homeowners, and they'll have to. There's going to be transactions in the near future, and even though the rate has started to come down, the effective rate will probably continue to go up in the
Right.
near future. And that impact on the real estate market, that's usually much faster because real estate is probably the most sensitive sector of interest rates sensitive, the most interest rate sensitive sector. It might happen in 2025. So that
Right.
that lagging effect is still there. And like you
Definitely.
said,
Yeah.
even though it takes time, it takes time for monetary policy to have an impact on the economy. Well, it's the same thing as they're starting to lower interest rate. It's gonna take time for that to really kickstart the economy. So for us, the risk of a slowdown is still very much in place.
Yeah, and
Yeah.
there's still, even like with the easing that has begun, there's still also a chance that inflation could become resurgent.
It could happen. I
Yeah.
mean, there's a lot of things that could exert upward pressure, but what we know for a fact is that while commodity prices have come down, demand for commodities has come down by a wide margin. Oil prices are down, and all of those are, usually when you get into a recession, it's always been accompanied in the past by exogenous upward supply shocks, whether it's oil price or something like that. So we're not seeing that right now, and that's
Right.
that's a positive thing. But yeah, so we have to monitor the fact that inflation may go back up. But the fact of the matter is that the only thing that remains robust right now, it's services prices, and it's linked very much to wage increases. And we know that wage increases have come down, and just the fact that the labor market has been softening, the quits rate is down, the hiring rate is down as well. So all of those are pointing to wage increases that will probably slow down to somewhere around 3%, which historically has always been coherent with a 2% target on total inflation. So we're not too worried about that. And if rates come, I don't think that we don't see rates coming down to like to a point where it would ignite demand in the U.S. So we're not too worried for that, at least for the next 12 to 24 months.
All right. And so let's talk about equities, Martin. With the U.S. election around the corner, what strategies are you implementing to manage the expected market volatility that you mentioned? And how do you see this affecting your current overweight position in U.S. equities?
Yes, that's a good question, and of course, every election is different. But there's always seems to be a volatility picking up towards November, and it's pretty obvious because there's a lot of uncertainty surrounding elections. So whether it's whether it's Democrats or Republicans. Usually it shouldn't have a big impact unless, like in 2016, Trump announced that he would lower corporate taxes by a wide margin. And obviously,
Right.
he got that for 4 years. So everything skyrocketed from that point on. But usually, we don't tend to pay too much attention to whether it's Republicans or Democrats. The importance for investors, obviously, is to be invested at all times. It's well documented that if you only invest while Republicans are at the helm, or if you invest only when the Democrats,
Right.
you'd be better off just to stay invested at all times. So we don't tend to look at that too much, but it's going to exert a little bit of upward volatility going forward. What happened just recently is that I don't know if you recall the last debate with Biden, that sort of gave wings to
Right.
the Trump presidency, and the stock market kind of liked that because they kind of remembered that what happened while he was when he was elected president in 2016. But for us, 2016 was a much different time than what we're observing right now.
Right.
We had just come off a little bit of a pullback, so stocks were oversold. PE ratios were much lower. The equity risk premium was better. Folks were well compensated for taking the risk. The fiscal discipline was much higher. I mean, the fiscal deficit was almost close to zero, and servicing the debt, because interest rates were almost at zero at that time, was much lower. So it was almost a given for him to just say, okay, I'm going to lower corporate taxes, and that was good for every stock indices
Right.
around the world. So this time around, it seems that it's got to be much more difficult. Like I said in the introduction, the difficulty, or the fact that the fiscal deficit is already somewhere around 6% of GDP. It makes it almost impossible for them to really lower corporate taxes or
Right.
even household taxes in the near future. So we don't see Trump being elected as good as what market are anticipating. So something that we need to monitor and embed in our forecasts.
Yeah, I mean, so much rhetoric, right? I mean, if you only considered the rhetoric, I mean, it's enough to drive anyone crazy. But when you actually look at what it takes to get legislation passed in the U.S., the likelihood of things changing dramatically is very, very low.
Yeah. But it's a close race.
Yeah.
Just now
Right.
for the White House, but then we don't know what the Senate will be, or what
That's it. Yeah.
the Congress will be like. So it's probably going to be a gridlock going forward. And then just in terms of election, right now Harris seems to be ahead in the polls, but as we know, it's usually there's 6 or 7 swing states in the U.S., and elections are always won within those 6 states, and it could go anywhere. So there's a
Yeah, it's
few
neck and neck.
paths.
Yeah.
Usually when whether Pennsylvania or Michigan or Wisconsin or Democrats, it's good. It's enough for them to have 270 electoral colleges.
Yeah.
But now I don't know. It could go anywhere.
Yeah, it looks like anyone's guess right now.
And having too much of an advance, I think, would be problematic for Harris. If it's a given or a no-brainer that she's going to win, people are not going to go out and vote. So there's still need
Yeah.
to have people go out and vote.
Well, the angst is good for that. So, Martin, we've seen some rotation towards more defensive sectors. How do you see this unfolding further? How do you see it evolving? And what adjustments are you considering for your sector allocations?
Mhm. You're right. And going back to your question earlier about our overweight U.S. equities, that's why we like the U.S., even though there's going to be a little bit of uncertainty surrounding the U.S. election. It's not going to last for very long, and eventually people will go back to, okay, where should we be invested? And the fact of the matter is that in the US, you got a bit of everything, sort of a barbell strategy where you got the defensive. Let's say let's say the risks are tilted to the downside. Right now, everybody's believing that the Fed is in a position where they can engineer a soft landing. So that's great. And if that happens, then lower rates will probably be good for growth stocks or tech stocks or even the Magnificent Seven, which are, a bit of a bargain or at a lower point or cheaper right now than they were at their recent peak. But then if there's a slowdown and you need to position for that, then the U.S. is also loaded with more defensive stocks. So the staples, healthcare, utilities will also benefit from probably lower interest rates in the near future. So the U.S. is a good market for that. It's got the growth on the one end, but it also got the defensive sectors on the other end. And for us, Canadian investors, it's always good to have a mix of Canadian equities and U.S. equities. It's like the best weather portfolio that you can have. So we're sticking to our guns, and we remain overweight U.S. equities for the near future, and the momentum is there.
Yeah.
Even though, like I said, Magnificent Seven have tanked a little bit, the rest of the market, the S&P 493, if you want,
Right.
has gone up and is making new highs. And even the equally weighted sectors are doing a little better than they have over the past 2 years or so. So
Yeah, I mean,
for us, it's still the way to go.
so we're still seeing expanding breadth
Mhm.
across the other 493 stocks in the S&P 500.
That's right.
Excellent. So with consensus earnings growth projected at around 10% for 2024 and 25, how confident are you that companies will continue to generate this growth against potential economic headwinds?
Well, it all comes down to that soft landing scenario. So if that happens, then and that means the consumer will remain fairly robust. And if the consumer is there, the spending will there, sales will be there, and earnings will, at the end of the day, will be there. But it always starts. Expectations in the market are always for the next year to start at somewhere around 10%. So historically,
Right.
it's always been that. Well, what's your expectations for 2026, Pierre? Go with 10%. It's a pretty good it's a pretty good bet. And then eventually they start to either decelerate or things, improve and they go elsewhere. But in a recession year, they always go down to somewhere around zero. And it's never happened in the past that we had a slowdown without sort of a pullback in earnings. So for us, it's kind of an eye-opening because when you look at where PE ratios are sitting right now, it means that there's no expansion of multiple possible at that point. It's
Right.
the last time that equities were this expensive was in 1995. So it's the only other time where we had a P ratio that was this expensive. For something to be careful about, and for us, risks are tilted to the downside from this point on. So we continue to work. We go week by week, month by month with this soft landing scenario. It could be the exception to the rule, but the fact of the matter is that usually when you see the unemployment rates start to deteriorate, it goes, faster than we think. And it's quite logic, it takes time to form your employees. It's
Right.
very difficult to get access to skilled labor. So you're going to wait for a few, you want to see that your sales are really coming down before you start laying off people. But if that happens, it could go fairly fast. So it hasn't happened just yet. The fact that the Fed has lowered interest rates is interesting and pointing in the right direction, but it may not be enough to really prevent the economy from slowing down. So like I said, for us, the risk is really tilted to the downside. And our analysis has shown that in past monetary tightening, when the SAM rule has been triggered, usually the Fed, which is kind of telling us that they could stop somewhere around 2.9% at the end of 2025,
Right.
would really need to bring rates down to 2%. So, probably 100 basis more of rate cuts.
Martin, I just wanted to say I love your monthly asset allocation strategy notes. I think they given what you just said, they very well reflect this month to month watching that you do, and I really enjoy reading it because it reflects the changes in sentiment and the changes in strategy very nicely with your plus and minus charts. It's a great
Thank you.
resource. So something dramatic would have to change in order for you to make any sort of wholesale adjustments to your strategic asset allocation.
You mean in terms of geographies or in terms of stocks and bonds?
In terms of what's happening geopolitically, in terms of what's happening economically
Yeah.
around the globe. I mean, in order for you
Boy,
to,
there's lots happening.
yeah.
There's lots happening around the globe. I mean, if you look at the two wars that are
Yeah.
ongoing and don't show any sign of stopping in the near future, there's a lot to worry about. But it's more in terms of the economic impact that we're not really seeing something that will prevent North America from continuing to. I always have the example of what's going to prevent Apple from selling iPhones or Coca-Cola from selling,
Right.
like colas. And we just don't see that right now. We think that, again, going back to our asset allocation, prudent approach, we're neutral. We're just waiting to see if if risks are really going to be tilted to the downside. And then even if there's a slowdown or worse, a recession, we still think that it's going to be shallow in nature, and any pullback going forward will be an opportunity to go back in the market. So that's why we don't want to be too defensive.
Right.
It was a mistake to be defensive in 2023 and parts of 2024. So market action is there. You have to listen to the market. There's a lot of information just in the market, so we have to listen to the market. But still, we have a prudent approach, and most of our indicators are telling us that risks are tilted to the downside, but we don't want to go outright defensive in our stance. So neutral, I think, is the right approach. And if there's a pullback, then we'll be ready to go back full tilt in the market if that happens. Basically, because we don't see too many imbalances.
Right.
Right now, even though the unemployment rate has gone up, it's still close to full employment. There's no really crisis that could happen. Or we often refer to the commercial lending or commercial real estate as one potential risk, but it's a small share of the pie in terms of loans. It's more regional banks that tend to do that. So for us,
Right.
it's not as it's not a systematic risk like the banking crisis, the real estate crisis that we got in 2007. And if you look at the stock market, yeah, it's expensive, but then the leadership is in super mega stocks. It's not like it's not a dot-com bubble or something that on the verge of imploding in my mind. So we don't see that many risk or imbalances out there that will have the economy derail to a point where an outright bear market of 30, 40, or even 50% like we got in 2007 is inevitable. So we're not there. So for us, any pullback of 10% from the current level would probably be an opportunity for us to go back in the market.
Interesting. So, Martin, any parting thoughts as we get deeper into October?
No, we're going to be monitoring things very closely. I mean, we always do, but this time around, it seems that the increased volatility going into the U.S. election, and then the two ongoing wars and the developments over there, especially in the Middle East, are kind of worrisome. So when the stock market is making new highs, for us, it's always an opportunity for a pullback, for taking profits. We don't want to get in front of a steamroller for sure.
Right.
But we find that markets are kind of expensive, and there could be indication of either consolidation in the market, which would be a good thing, or worse, some form of pullback. So we really need to monitor the the unemployment rate going forward. Just as much as inflation was on everybody's lips in 2023,
Right.
we think that the rest of the year in 2025 will be all about the labor market.
Martin, thank you so much. That was very interesting, very comprehensive. Thank you so much for your incredibly valuable time and your insight.
Excellent. Thank you very much, Pierre, and always a pleasure.